world has withstood multiple shocks, and I call it triple shocks of COVID-19 pandemic, then the war in Ukraine, and now the financial market turmoil. The financial market turmoil is mainly emanating from the synchronized monetary policy tightening across the world by central banks, especially the advanced country central banks, led by the US Fed. And naturally, the spillovers are felt by the emerging market economies, like including India. So, in this kind of successive, turmoil that the world has gone through, that has left the entire European Union is today facing a recession situation. They're on the brink of a recession, but there are possibilities that they will avoid that. United States is holding stable, but there are other countries also where the growth has slowed down. Now, so far as India is concerned, economy, overall macroeconomic fundamentals, the financial sector stability, all these aspects, they remain resilient. The banking sector, that is the financial sector, is stable because all the parameters with regard to banking or the non-banking lenders or the other major financial sector players, you look at the data, I don't want to, load too much of data on you. They are stable. Overall, the financial sector in India is stable. The growth numbers are looking good in the current context. Our estimate is that India will this year grow by about 7%. The IMF has projected that India will grow by about 6.8% in the current year. And that puts India among the fastest growing major economies in the world. We have a major challenge with regard to inflation, but comparatively, if you see, our target, the upper ceiling is about 6%. The last inflation number which was released for September, the inflation was 7.4%. We expect the October number which will be released on Monday, we expect that to be lower than 7%. So therefore, inflation is a matter of concern with which we are now dealing effectively. For the last 6 months or 7 months, we have taken a number of steps. We have increased the interest rates, and government also has undertaken several supply-side measures. So overall, just to sum up, the macroeconomic fundamentals of India remain strong and resilient. Growth prospects are looking good. As we assume the G20 presidency in 2023, I think India is taking over the presidency of G23 at a time, in a year which is perhaps the most challenging year in modern times, and we are assuming presidency of G20 with stronger macroeconomic fundamentals compared to many other countries.
Inflation, you spoke about inflation, and in keeping with your mandate, one part of your mandate as central bank is inflation management. You sent a letter to the government explaining the whole process of management of inflation and why it is still above the band. Can you tell us what you said in that letter, or is that information confidential?
No, what we have written in the letter, I think anybody can make an intelligent guess. Basically, the law requires that when for 3 consecutive quarters the inflation remains above 6%, it will be treated as a failure of monetary policy, and the Reserve Bank is required to write a letter to the government highlighting 3 things. Number 1, what are the reasons for which it has happened? What are the principal reasons behind that? Number 2, what steps the Reserve Bank proposes to undertake to bring it down below 6% and closer to 4%, which is the target rate. And number 3, what is the time frame within which we expect inflation to come back to the target level? So we have broadly explained the reasons as to why it happened, and I have spoken about it on several occasions. In fact, I think about a week ago, I also spoke in one conference in Mumbai, where I have explained why the inflation went up in India. Now, in February this year, when we met in the Monetary Policy Committee, our inflation projection, and which was not different from what the market, the professional forecasters were estimating, we projected in February this year that our average inflation in 22-23 financial year will be about 4.5%. We did stress tests assuming crude oil even at $100. And we found that even at $100 per barrel of crude oil, the inflation would be maximum 5%. That was the estimate we had made in February. Then on 24th February, the war started, and naturally it completely changed the picture. And thereafter, the crude oil hit $130 per barrel before coming down to $120. It remained around $120, $110 for considerable period of time. Now, of course, it has come below 100, but it ranges between 93, 95, 96. So in February, it looked that the inflation is well under control and India is well on course to reach the target of 4%. But the geopolitical crisis, the sudden spike in commodity prices, the sudden spike in edible oil prices, the sudden spike in prices of cereals, wheat, for example. We have surplus wheat, but price of wheat in India also went up because we are a part of the globalized world, and the international prices of wheat went up because from the Black Sea region, a lot of wheat exports goes into the rest of the world. So we were impacted by major external factors, and the entire inflation picture underwent a particular change.
If oil stays where it is, or it continues to range round about what you're saying it will range at, which seems like a conservative estimate, right? I mean, $95, it could go up. The problem is we don't know what is going to happen with the war. It seems to be a war without end. And global inflation isn't easing. There's already some talk that maybe we need to revise our inflation band, that we've got a certain inflation band, maybe India's inflation target needs to be revised upwards. What is your thinking on this?
You see, there is a reason why the target has been kept at 4%. There was a committee in the Reserve Bank which it was an internal committee of the Reserve Bank, which did a detailed analysis and found that 4% inflation target with a price band of plus minus 2%, so that we have a range of 2 to 6%. And the RBI research at that point of time found, and even now that holds good, that inflation above 6% for India would be detrimental to growth. It will be counterproductive because it will act, it will act through a negative loop. You will have, if it is above 6%, the financial savings will be hit, the investment climate will hit, India will lose the confidence of international investors if it remains above 6% for a prolonged period. So any inflation above 6% is detrimental to growth. So therefore, 6% has been kept as the upper tolerance band. And the fact that we have a tolerance band, between 4 and 6%, that gives RBI enough policy space to use during times of stress, as we did during the COVID-19 pandemic. Although the inflation was about 5.5%, the Monetary Policy Committee very consciously and quite rightly decided to tolerate higher inflation because during COVID, the priority was to support the economy by keeping liquidity easy, by keeping the interest rates lower. During COVID, we could not, when the COVID had still not ended, when the economy was still facing a lot of stress, and that year we had a negative growth, a negative growth in India after a long, long time. So therefore, that was not the time to start your monetary policy tightening. So this range we have between 4 to 6% gave us the flexibility to keep the monetary policy supportive of the economy, and we decided to deal with the inflation at a later date, that is after things are under control. So this year in April, when we started the change in our stance, last year's growth, 21-22 growth, I think that last year's growth was, what was the growth last year? It was about, 7.7%. It was 7.7%. And so that was the time we changed course. So coming back to your principal question, is it the time to change the interest rate, the whole regime? I would say that 6% target, that is 2 to 6% with 4% as the main target, makes a lot of economic sense. And we should not think of shifting the goalpost because, because we have not been able to meet it. We remain committed to bring it down, bring the inflation down to 4% over a period of time.
Question that follows is simply whether the shocks that you spoke of, the externalities, are they unprecedented enough for us to think in terms of making a change, or do you think these are shocks that you've negotiated before as a country and can negotiate again?
No, it's too early. In fact, I would not like this debate to start prematurely. I think it's too premature to enter into that debate. It will only mean less commitment of central banks to fight the war against inflation.
Let's move on to the rupee. You've repeatedly said that RBI does not have a preferred band for the rupee-dollar exchange rate. But you've also been intervening off and on in the forex markets. Is there a medium-term, long-term kind of method to this intervention? When do you choose to intervene? Why do you intervene?
You see, our intervention depends on, it's impacted by day-to-day developments. Some data point comes. 2 days ago, the US CPI inflation data came, and the rupee appreciated by, from 80, by 1 rupee. From 82.80, it came down to, from 81.80, it came down to 80.80 yesterday. Now, on a day-to-day basis, there are developments. There are also situations where somebody makes a statement somewhere. Some statement emanates from, advanced countries, and that impacts the market. We also study what kind of flows, inflows and outflows are taking place on a day-to-day basis. Many of the inflows and outflows are easier to anticipate. We would have anticipated them, but there are also some unanticipated, unexpected, flows, both inward as well as outward. So the strategy is decided that, on a day-to-day basis, within a broad, within the broad underlying theme, which has principally 3 objectives. One is to prevent excessive volatility of the currency movement. You cannot have a situation where suddenly in a matter of 2-3 days, there will be a sudden crash in the prices of, in the exchange rate of the rupee. So the first objective is to prevent excessive volatility and facilitate and ensure an orderly evolution in the exchange rate of the rupee. Orderly evolution in both directions, while it is appreciating and while it is depreciating. In fact, if you recall, when there were heavy inflows during the pandemic year, 2020 and 21, that is the time we built up our reserves. We were just, picking up dollars in the market, and we built up our reserves because we knew that the reserves which are coming with great speed will flow out at some stage, and we have to be prepared for that. So the reserves went up from about $400 to $642, which was the peak. Now, we built up this $240 because we knew that there will be a reversal of situation where we will have to provide dollars to the market. And the market, at one point of time, there was no dollar supply in the market. It was only Reserve Bank which was supplying the dollars. So therefore, we started intervening in the market, which means we were selling dollars. Now, there were some observations made that RBI is, using these reserves indiscriminately. It's not so. We picked up these reserves only for this rainy day. And when it rains, I have said it earlier also, you have to pick up your umbrella and use it. We didn't pick up reserves just to keep it as a showpiece in the Reserve Bank of India. And even at this point of time, our reserves are very comfortable. So the first objective of our market intervention in the forex market is to ensure an orderly movement of the exchange rate. Second is to anchor market expectations. Because if the Reserve Bank or the central bank doesn't intervene, the market takes it that, okay, the rupee will just depreciate, and Reserve Bank is indifferent and agnostic to it. So that will fuel further depreciation. So we will have to anchor expectations in both directions again, both when it is appreciating and when it is depreciating. And the third, a stable exchange rate regime is the underlying, is at the core of the overall financial stability of a system.
What is the central bank's approach to governing new age financial products and companies, which needs to balance governance on one side, prudence, governance, consumer protection, and on the other side, facilitate innovation and growth of fintech in the country?
You see, the Reserve Bank, we are very supportive of innovation, but every innovation has to be well regulated when it is actually implemented as when it is commercialized or when it is implemented as a financial, as a financial intermediary or as a part of the financial system. This has been a problem area. There were complaints of customer harassment and problems of excessive interest rates being charged, and there were some cases of harassment of the borrowers, and this became more felt especially during COVID, when perhaps because of lockdown and all, the unauthorized lenders, when they started giving pre-approved loans, people started taking the loans. So we at that time, I think as early as June in 2020, we had issued a fair practices code for all entities. And thereafter, we constituted a committee. And about 6 months ago, we have come out with our guidelines for the digital lending. We have issued digital lending, a regulatory framework for digital lending, with principal focus on customer protection, on transparency of the loan product. In fact, we have said that every digital lender must have a key fact statement, KFS, a key fact statement, which should clearly reflect the rate of interest in an annualized manner, the interest rate as well as other charges in an annualized manner. So the guidelines are very robust, and it has been well received in the market.
What about the CBDC? You've made there's a pilot which is now going on. Tell us a little more about this. And fundamentally, is there a functional benefit to digital currencies, or is it one of those nice-to-have things?
No, it has a fundamental benefit. The world is changing. The way business is done is changing. Technology is evolving very fast, and you have to keep pace with the times. That is that's a kind of a motherhood way of looking at the whole issue. But more specifically, you see, printing of notes, currency notes, paper notes, it involves cost. It involves cost of printing, cost of buying paper, cost of logistics, cost of storage, and the entire logistics and everything. It requires a lot of effort and a lot of cost. This will be going forward much less costly in terms of, compared to the paper currencies. That is number one, it will be less costly. And number two, this is something which will become very important for cross-border transactions and for cross-border payments. Today, when money is, let us say, remitted or transferred on a cross-country basis, on an average, according to a World Bank report, the average charges are about 6%. When CBDC comes in, let us say, in a group of countries,
it will be much lower.
The costs will be practically, very marginal, very marginal. It will be the cost of overheads of our system, their system. It will be substantially minimized. And it will be instantaneous. Of course, you may ask a question that even now under UPI, we are working for real-time transfer of money. In fact, between India and several other countries like Singapore, the United Arab Emirates, other Gulf countries, already the UPI is being linked so that the real-time transfer of money takes place between India and those countries. You may say that this is happening. But UPI is a payment system, whereas this is a currency system. UPI facilitates the payments to take place. Here the currency itself, the currency issued by the central bank, will get transmitted. And this is less costly. It will facilitate international payments, cross-border payments. It will be good for exporters and importers. And I think the future belongs to technology. And there could be a time where, half the world or more than half the world would be on digital currency, and you cannot be on paper currency. You have to be sort of moving in, in tune with the changing technological developments.
Moving on to a slightly more macro question. Before the pandemic, there was this consistent debate, not just in India, but in many parts of the world, on the autonomy and independence of central banks and of the role of government. And what we've seen since is central banks and governments increasingly having to act in concert. What are your views on this?
You see, when I joined the Reserve Bank of India on 12th of December 2018, on the first day I had a press conference in which I had said that the monetary authority, namely the Reserve Bank, and the government, which is the fiscal authority, there has to be coordination, because both are working in the interest of the economy. Both are in the business of ensuring public good. And these two institutions need to talk to each other, need to engage with each other. The process of consultation has to prevail because both are dealing with the economy. What you say that in certain countries, central bank autonomy, let me tell you very clearly that so far as India is concerned, now what does autonomy mean? Autonomy means autonomy in decision making. If I talk to somebody in government, or if there is an engagement with the government, and there is an interdependence of the government with the RBI and the RBI with the government needs the RBI for, financial inclusion, for digital payments, for so many things. The Reserve Bank also needs the government because we need legislative changes. And let me also mention that many legislative changes which have been carried out over the last 3 or 4 years, we got additional powers to regulate the NBFCs. We got additional powers to deal with the problem of the urban cooperative banks. We got the housing finance companies which were earlier regulated by the National Housing Bank. They had to be, they were transferred to the RBI because there is no difference between a housing finance company and a NBFC. So we also need the support of the government. And ultimately, if the economy has to do well, both fiscal and monetary authorities will have to work in close coordination. And this coordination, this conversation, let me mention that it happens all over the world. It's not something peculiar to India. It happens all over the world, but various kind of extraneous noises come from time to time. But there is a close coordination, there is a constant engagement between the Treasury and the Monetary Authority, between the finance ministries and the monetary authorities world over. It's nothing unusual, and especially in COVID times, even the conventional purists have now recognized that to deal with stress situations like the COVID situation, there has to be proper coordination between the monetary and the fiscal authorities. And a coordination and engagement does not mean compromise of autonomy. Nobody interferes in each other's work, but we share our views. Look at the issue of inflation. While we have taken several monetary measures by controlling liquidity, by raising interest rates and several other measures, the government has undertaken supply-side measures, in terms of bringing down the taxes on petrol, diesel, reducing the import duty on edible oil, on pulses, which have had a positive impact on inflation. So there is an interdependence between the two.
You have to act in concert. Governor Das, thank you very much. It was a pleasure having you here, and I'm sure our audience is going back feeling very secure that we have a stable hand at the wheel. Thank you.